Hi everybody and welcome back to the second class of the Investing Masterclass. Today we're going to talk about the fundamentals of the stock market and everything you need to know to be prepared to have a plan before you invest. Let's start right now. Here is what we're going to cover in this video. We will see the foundational investing terms, so the basic words in investing, so that we will have a foundation and everything will be built on this word. So in order to not get lost, I will explain these terms. We will also see the stock market cycles, and I will teach you how everything in the stock market is a cycle, a bull cycle, a bear cycle, and history rhymes in this industry. So you have to understand how everything works. I will also teach you the differences between long-term investing and short-term investing. This is really important. And I will teach you how you can set smart financial goals, because you have to understand yourself to understand what your portfolio will look like. Your style of investing depends on your risk tolerance, and that's also why we will cover the risk and reward of investing. It's really important. And finally, we will see the emotional part of investing that you have to be aware of before you invest. And if you want to go faster, the pro tip is to watch the video at 2x speed. Okay, so let's start with the most common investment terms. It's really important that you know them because we will use them more and more as the time passes, as the classes advance. So it's really important that you are familiar with these terms. Let's start with what a stock is. It's a partial ownership of a public business. For example, if you own a share of McDonald's, you have 0.0001% of McDonald's. That's the main thing you have to understand about what a stock is. The portfolio is a basket of assets. So it can be a stock portfolio, so a basket of stocks. If you have 10 stocks, it's a collection of 10 stocks. You have a stock portfolio. A stock market index is a list of stocks that represent a whole market, a whole sector, an industry. For example, it can be the S&P 500 for the leading 500 American businesses, or another example is the CAC 40 for the leading 40 French businesses. Okay, now a dividend is a reward paid to the shareholders for their investments in the company's stock. That's at the end of the year, a company has some cash and doesn't see reinvestment opportunities, so they reward shareholders, they give them cash. Generally, the dividends are paid every 3 months, but it can be also every 6 months or every year. It depends on the company, but generally every 3 months. Also, I will add that not all companies pay dividends. If they think that they have more reinvestment opportunities and all the cash that they have at the end of the year, they want to reinvest it, well, they will reinvest it. Take, for example, Google. The company is called Alphabet, and they don't pay dividends. They just reinvest in the business again and again and again. On the contrary, you see businesses that don't see reinvestment opportunities, and they say, okay, at the end of the year, we have some cash and we will pay a big dividend to shareholders. So you can have a dividend yield of 7%, 8%. That's a strategy that companies make at the end of the year. What do they do with the cash? Now let's talk about return on investment. The ROI is a measure of how much money an investor has earned or lost on an investment relative to the amount of money that was initially invested. If the stock that you bought went up 20%, your return on investment is 20%. If a stock goes down by 20%, the return on investment is negative and it's minus 20%. Okay, let's continue with what a risk is. It's the uncertainty with respect to your investments that can negatively impact your financial welfare. Basically, what can go wrong? Your investment value might rise or fall because of market conditions. The big risk that you have to be aware of is the permanent loss of capital. So losing everything you have, losing 50% of what you have, because a lot of problems in the stock market are temporary. We've seen it with the pandemic, where we had a big crash and then everything rebounded really fast. So that was temporary. But for the people that sold their positions at the bottom of the crash in 2020, well, for them, it was a permanent loss of capital. That's the biggest risk. Finally, commodities are goods that include agricultural products like metals, oil, natural gas, coffee, etc., etc. Not because I want to teach you how to trade commodities, it's just that some companies deal with commodities, for example, natural gas companies, oil companies. So now we have the big picture. Now the stock market has two types of markets, a bear market and a bull market. It's a cycle and things go up and down, basically. You have a bear market with a lot of pessimism where markets go down. The official loss that you need to be an official bear market is a 20% loss. For example, if the S&P 500 loses 20% of its value, then you can officially say it's a bear market. Well, the bull market is the opposite. It's optimism. It's if an index or a stock rises 20%. So you have two types of markets, but they operate very differently. For example, in these slides, you can see that bull markets are much longer than bear markets. The blue lines are bull markets. The orange lines are bear markets. What they say is that in bull markets, you take the stairs. In bear markets, you take the elevator. It's really brutal most of the time. And this phenomenon of cycles has happened for centuries. It's not recent because it's part of the human mind of being euphoric or very pessimistic, and the stock market participants are humans. Even though you have algorithms now, well, people that operate the algorithms, they are humans, so they have emotions, and the future will look like this also. You will have cycles, really strong bull markets, really strong bear markets is part of the life, and you have to be aware of this. And this phenomenon of cycles in bull market, bear market, well, every time you have a cycle of emotions, and that's why you have these cycles. It's because the human brain goes from optimism to euphoria, where everybody gets into a stock, into a sector. We've seen this phenomenon in 2000 for the dot-com bubble, and then the bubble pops and everybody panics and there is some capitulation, some depression, and then optimism again. That's part of the journey, and you will go through every emotions you see here, and you will most likely say these sentences of feeling great about an investment, of saying markets are just for me. You have to understand that it's part of the process. And even if you're aware of this risk, I'm sure you will say these sentences. Okay, but these cycles are not smooth. In these slides, you can see that the ride up the bull market can be very strong, and you can double or triple your money very fast if you're in a good stock or in a good industry, a good sector. It is also truth that in this situation, this bubble situation, you can lose your money very fast also. And investors in the stock market tend to panic very fast. So the sentiment can shift very quickly. Now that you are aware of these risks, you have an edge if you invest for the long term. All this phenomenon of bubble and irrationality and emotions, that's things for the short term, for days of investing, weeks, months. If you think about years, things get smooth. And all the small change, up, down, bull market, bear market, if you think of years and decades, well, you will only see the prices go up. You will not worry about short-term fluctuations. That's very important because if you see the media, the news, they will talk 99% of the time about the short-term fluctuations, short-term moves. What did the S&P 500 do today? What did the Dow Jones do today? These news and these drama are part of the stock market. But again, if you think investing for the long term, in years, decades, you will be much more emotionally stable, and that's better for you. Benjamin Graham, the father of value investing and Warren Buffett's teacher, said that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. What this means is that in the long term, the intrinsic value of an investment emerges. In the short term, everything can happen. But if you do your fundamental analysis right, and if you say Starbucks stock is worth $200, if you do the work, well, the price of the stock will reach its intrinsic value. But you will see that after years, not after weeks or months. You will have to be patient. You have to be patient and you have to set smart financial goals because every investor is different and you have to know yourself. So before investing, have a plan. You need to have a specific goal. What do you want out of the stock market? You have to state what you will do to reach your financial freedom. Your goal must be measurable. So provide a way to evaluate with numbers what you will reach. Do you want a portfolio that will reach 5% annually, 10% annually? What is the return that you want so that you will sleep well at night, knowing that your portfolio works for you? But you also need to be aware that you will not reach 30% annually for 30 years. That's very, very hard to do. So your goals must be achievable within your scope. If you're a complete beginner, don't expect 20% per year. If you're at an advanced level, you can be more optimistic and reach more than 10%. But you need to have specific goals that are reasonable to your level. At the beginning, start small and you can increase your risk appetite over the years to have more returns. Your goals must be relevant, so make sense with your job function. If you don't have the time to study stocks and study market, maybe it would be better for you to just invest in the S&P 500 index because these analysis of stocks and markets, this is very time consuming. So be aware of this. And finally, your goal must be time bound. State when you will get it done. Do you want to build a portfolio in 1 week or do you want to study first and after 3 months you will create your first portfolio? Some people want to create their portfolio and learn along the way. They just start with some stocks. And as they started investing, they continue learning and learning and learning. But for other people, they wait some weeks, some months before taking action. That's part of your strategy. And you have to know yourself what kind of person you are before you invest in the stock market. And these smart letters are important to have clear goals to guide your investment strategy. For example, some people, they want 25% per year. Some people want 5% per year, but they don't want to lose money. The big question that you have to ask yourself is what is your risk tolerance? Are you a type of person that is risk averse or do you want big returns? You have to know yourself. Because if you're risk averse and you start to invest in risky situations, well, you will not sleep well at night. And I want you to sleep well at night. If you're risk averse, for example, the solution would be diversification. For example, instead of having 10 stocks in your portfolio, just have 50. So when a company goes bankrupt and the stock goes to zero, well, you have 49 other stocks in your portfolio and the risk allocation is minimal. Another tool to have a risk-averse portfolio is to only invest in safe companies that don't have debt. And if you don't have debt, well, you can't go bankrupt. That's part of being a safe company. You want to invest in strong, profitable companies that generate a lot of money, that won't go bankrupt. That's part of being a safe company. If you're risk averse, that could be a strategy. But also, if you're not risk averse, but you don't like very, very high risk, well, you can have a 50% safe, 50% risky portfolio. That's average, and you see how it goes. What is really important that you understand is that volatility is not risk. Risk is the permanent loss of capital. And volatility is just when stock goes down and up and way down and way up. And it's okay if you don't buy and don't sell, you just hold the stock. Well, it can go up and down. But at the end of many years, it will be at the same position. It doesn't matter. If it's a risk, if you think you can panic, and if it goes down by 40%, you think, okay, I'm out, and that's a permanent loss of capital. Volatility is not risk. Volatility is part of the investing game. And if you think a stock is worth 200 and it has high volatility, the stock goes down by 40%, well, you have a discount. You can buy more of this stock because it's cheap. So volatility is not risk, it's an opportunity to buy at lower price. If you're confident in your strategy and you think the intrinsic value of a stock is $200. Also, in general, big returns often come from risky stocks, but not always. You can make a lot of money and have some great returns investing in okay company, in fair companies. If, for example, if you're lucky and you invest in a normal company and somebody buys out your company, the stock goes up, you have a strong return, you've just been lucky, you have done nothing, but that can work in the stock market. Luck happens in the stock market. The best scenario you can have is to invest in a wonderful company that generates wonderful returns. In the next modules, I will show you companies, wonderful companies that have generated 20% returns annually for 10 years, 15 years, 20 years. It happens. And in the next modules, I will tell you how to identify these companies so that you can also invest in these companies, wonderful companies. And if you're in the lucky situation of being an owner, a stock owner of these companies, well, you don't need to diversify. You just need 5 stocks. You just invest in 5 wonderful companies and sleep well for 20 years. That's part of some investors, some big investors have done this. Finally, if you want to have more returns and you are ready for more risk, psychology is very important. The most important organ is not the brain, it's the stomach. Once you have done all the accounting, you have done the valuation, the intrinsic value, you say, okay, this stock is worth 200, I buy it at 100, it's an easy double, and the stock goes down by 50% day one of your stock holding. Well, it makes you think about, okay, what did I do wrong? What does everyone know and I don't know? The news on TV are terrible. That's part of the game. So I would say that the stock market is 20% brain and 80% stomach. For example, I've taken the performance of 2 stocks over 20 years. Netflix, with the performance since 2023 of 67,000%. That means a 36% return every year on average. CAGR is compounded annual growth return. So on average, it's as if you had 36% per year, 36 for 20 years. That's huge. And also, let's see the returns of Coca-Cola since 2003 that did plus 159%. That's a shy, almost 5% CAGR over 20 years. If you look at this chart, you can see a strong outperformance from Netflix compared to the S&P 500 for a decade, I would say. So it's easy to say, okay, that's a wonderful investment. I should have bought at the beginning. What you don't see is that these can happen. These crash can happen. And this happened for Netflix in 2022. where the stock lost 70% of its value. That means that you can be holding the stock for 5 years, 6 years, and then lose everything because there is some drama, some market news, some events. In 2022, there was a panic for Netflix stock because the growth in subscribers decreased substantially, and that impacts the whole business model of Netflix. That is known to be a growth stock with growth in subscribers count. And when people lost 70% of their investment in Netflix, they just said, okay, this stock is dead, I'm out. You have to be aware of this risk of losing 70% of your investment if you want to take more risk. And in this chart, okay, this is not up to date with 2022, but I think you get the idea. This 70% crash didn't happen once. It happened in 2005 with a 70% loss. It happened also a bit before in 2022 with also a 70% loss, and in 2008 a 50% loss, and in 2012 a 80% loss, and now in 2022 a 70% loss. Looking at the rear view mirror, you can say, okay, it was a wonderful investment. I should have bought more Netflix at the beginning. I knew it. But are you willing to suffer for years after the 80% drawdown? It's just brutal, and that's part of investing in risky businesses, growth businesses, sexy businesses. You have to be aware of this risk because this will happen again and again and again. In 2000, Amazon was a great company growing really fast, not the Amazon we know now, but there was a lot of hype around the stock. Everybody wanted to invest in the next new thing. And when the dot-com bubble popped, Amazon stock lost 90% of its value. I think it was 97% of its value. And in the letter to shareholders at the time, Jeff Bezos said that even though the stock lost more than 90% of its value, the business is growing fine. There was no fundamental issue. Revenue is going up, the number of customers is going up, the logistics are getting bigger and bigger. Everything is doing fine at Amazon. It's just that the markets were very euphoric at the time, and Amazon shareholders suffered a 97% loss. Imagine losing 90% of your investment in 1 year. That's almost unbelievable, but it happened in the past and it will happen in the future. And these sell-offs happen for sometimes emotions of the stock market, typical cycle, bull market, bear market, market sentiment, etc. But sometimes it happens because of a fundamental change in the business. For example, in 2011, 2012, Netflix had this problem of a decrease in subscribers growth. Same in 2022. Sometimes there is a little something that grows into an enormous fire, and the whole market sentiment about Netflix changes, and they just say, get me out at any price, get me out, can get me out, and it goes really fast. So the big question is, if you want more returns, more risk, are you prepared for volatility? If you compare Netflix performance 36% per year and Coca-Cola's performance, which is 5% per year, well, you have two types of investment. One with high volatility, where you must survive and hold for years, and one with low volatility, with stable returns, generating 4.6% per year, where you can sleep well at night. Some people prefer investing in safe companies, and I completely understand that. They don't want to lose their hair about investing in the stock market. And one of the best investors of all time, Peter Lynch, said that the key organ here is not the brain, is the stomach. When things start to decline, there are bad headlines in the papers and on television. Will you have the stomach for the market volatility and the broad-based pessimism that tends to come with it. Because if Netflix, for example, starts to lose subscribers, numbers of subscribers, it will be everywhere in the news. It will be on the Twitter feed. It will be everywhere. And you will see your investment losing 60%, 70% of its value. So maybe you believe in Netflix, you believe in a strong management, you believe in the vision of the company, but everybody around you will say that it's a very bad business. It's a horrible business. Market experts on TV will say very bad things about Netflix. Everybody will get pessimistic, and the stock price continues to go down and down. You have a minus 80%. And again, the people on media start talking about, okay, Netflix is dead. You have some big titles. Netflix is dead. You have to be aware that this will happen to you in the future if you want to invest in risky companies. And you could say, I just buy more when the stock goes down. But remember, nobody can predict the stock market and nobody can time the stock market. It means that you can say, okay, I'm a shareholder of Netflix. The price goes down by 50%. I just buy more at this time. And then it can only go up because it happens many times in the future, etc., etc. Well, for this 2022 crash, for example, the stock got cut in half and then continues its downward pressure down to 75%. So again, it got cut in half again. So even though your starting point is cheap, it can also lose again 50% of its value. You have to be aware of this. Nobody can time the stock market. Nobody can know when the stock will go up again. And nobody knows if the stock will go up again. There are a lot of companies that were growth, sexy businesses that went down 80% and never bounced back because management had some issue, the company had some issue, there were other competitors that ate their meal, and you will see people on TV make forecasts. They will say, okay, Netflix is at the bottom, the stock is at the bottom, now it will go up by 20% in the next year, etc. They will continue to make these forecasts because people like hearing people making forecasts. They like, if you're a shareholder of Netflix and you've lost 80% of your money on the stock, you like hearing an expert say good things about your company. That's reassuring, but that's pointless because nobody knows what will happen in the future in the stock market. The best investor in the world, Warren Buffett, doesn't attempt to forecast the market. He says that his efforts are devoted to finding undervalued securities. He analyzes businesses and tries to find cheap stock. He doesn't try to predict the stock market. He doesn't try to understand how the stock will react 1 week from now, 1 month from now. He says it's pointless. So if the best investor in the world, the god of investing, says that it's pointless to do forecast, well, my advice is don't try to do forecast. It may be fun, okay, but completely pointless. Warren Buffett also says, I have no use whatsoever for projections or forecasts from other people. They create an illusion of apparent precision. The more meticulous they are, the more cornered you should be. We never look at projections, but we care very much about and look very deeply at track records. If a company has a lousy track record but a very bright future, we will miss the opportunity. What he's saying here is that if a management, take for example Netflix, if in the past management has taken good actions when the stock went down 80%, if the management was resilient and responsible and very competent at what they're doing, that's a good track record. It means that management doesn't panic, and despite all the market fluctuations, the business is still strong. Well, you have a good track record. That's what Warren Buffett is interested in. If you have a very bad track record, a change in management every year, some irrational decisions from a company, that's a bad track record. If the revenue in the past are going down and down, the earnings of a company are going down and down, that's a bad track record, and Warren Buffett is not interested. in this kind of investments. In this module, we will try to emulate and learn from the best investors in the world. So we'll clone their strategy. If they focus on track record, we will focus on track record. That's part of the game to be a better investor. I believe that if you copy Warren Buffett in everything he does to invest in the stock market, you copy his strategy, you can only improve. And that's why you're here. The important things to remember is that you can't time the market. Everything can happen, but you can take advantage of volatility with a consistent method. Let me introduce the dollar cost average, or DCA. It's amounts of money that you put in the stock market every month, every year, regardless of valuation, regardless of price. If you think Netflix is a good business, just say to yourself, okay, I'm putting $1,000 into Netflix stock every month. And as you see in this chart, if the price goes down and you buy Netflix stock, well, with $1,000, if there is a discount, you will be able to buy more. If the stock price goes up and you buy at this time, well, you will buy less stock with $1,000. Again, if the stock goes down, you will be able to buy at a discount. So with $1,000, you can buy more groceries, more Netflix stock, and again and again and again. So you just separate yourself from the emotional part of investing and you invest consistently. It's easier said than done because a lot of people try this and they wait for the market to go down before investing. So my advice is to do it automatically with your brokerage account, with your bank. You say, okay, every month this will happen. So you don't have to log in the platform and do it yourself. You remove your emotions from the equation. And this DCA method gives you low stress. And that's the key to success for a lot of people. You just stick with the plan, no matter what the market does on a particular day of week. You don't panic. Every first of the month, you just buy something. That's it. Okay, so let's do the summary. You have understood how the market cycles work. With the bull market, bear markets, everything happens in the cycle, history rhymes, etc. You have understood that you have to know yourself and you have to know your risk tolerance to see what kind of investment strategy will fit you. Also, it's important to set realistic goals for your future so that you can reach your objective and have a plan for this. And you have to be prepared to hold through volatility. It can happen and it can be very painful, so you have to be prepared for it. And that's it for this class. I see you in the next lesson.